Alright, so here's just a quick little tutorial about insurance renewals for the end of financial year, but also actually just renewals every 12 months that you do normally. If you are getting insurance for the first time, then sometimes it can be hard to estimate your income for the following year. But it's kind of like tax and all those other things. You kind of just give your best guesstimate. Now, I've had a query from someone just now in regards to business interruption, and different insurances are different, right? So business interruption covers for when you're not able to run your business because of maybe the electricity went down and you couldn't turn on your computer and you couldn't service clients and whatnot. Now, they may ask for an income prediction for the following financial year as a revenue figure or as a net profit figure. Now, for business interruption, if you think about it, it's replacing the income you would otherwise receive. So it's actually your gross profit is usually what they're wanting. So we'll do a quick exercise. We'll just use easy figures to make it easy to understand. So let's say you've brought in this current financial year, you've brought in $50,000 worth of sales, and you're a product-based business, and the products have cost you, let's say, $20,000. So this is your cost of goods sold, otherwise seen as COGS or COS, which is cost of goods, and that's just the cost of your product, the raw materials you buy to then be able to sell. So here's all your income, less your cost of product, and this gives you your gross profit. Now, if you have only been trading since October, say, for example, October, November, December, January, February, March, you're only doing 6 months. So if you want a 12-month estimate, you're going to multiply it by 2 to get a $60,000 estimate as your net profit. And likewise, your sales, you're going to estimate that to be 100. For the following year, if you're growing and the last couple of months has been more, you want to estimate it as more, so you don't end up paying. So if anything were to happen, you'd get cover for the most that you want cover for. Kind of like tax, except tax is worse in that you will pay penalties or interest if you have underestimated your income. So let's say you think you can do more and you're actually probably going to do $150,000 this following year, then this is likely to go up as well. So let's say your estimate for next year is going to be $150,000 in sales. Your cost of goods sold is going to be $60,000. So keeping it in line, it's the same cost of the product, so it's going to be the same. Except you may choose a different provider, or you may cut costs on some other part of the product, so you may even reduce that to 50. So what happens is your gross profit then goes to 100,000. So you want cover for your business interruption insurance based on your best estimate for the next year of $100,000. So that's your gross profit. This is GP, or gross profit. Then under all here, you've got all your other expenses. So you've got rent, phone, home office expenses, all that sort of stuff. Only then does that, down the bottom, say that's $20,000 for the year, or the last 6 months. Then your net profit is $10,000. So when they talk about gross profit or net profit, it's really different. Can you see that? So that's your net profit after all expenses. Your gross profit is only after your cost of goods. So if you're estimating it, if they're wanting your net profit, it's this bottom line after all the expenses. But if you're wanting gross profit, it's your sales less cost of goods. That's what gross profit is. Everything else comes under expenses, and then what you've left over is net profit. So again, when you're estimating tax, you're basing it off your net profit, your estimate for the next year is based off your net profit. You don't pay tax on gross profit, it's a net profit. So hopefully I haven't confused anyone too much, but otherwise just post your question below and I will answer it.